Welcome back, viewers. Today we are starting our series on process costing, and before we look at it, allow me to take you through some of the costing methods. Of course, when you're looking at costing methods, we have, first of all, these are the methods that are helping us to accumulate the costs that we are going to be incurring in the production of whatever we shall be producing, whether manufacturing or whether we are just purchasing them. So there are some of the common costing methods that we use in cost and management accounting, but with the respect to this level, I'm going to be talking about only two. We have the specific order costing that includes both the job costing, contract costing, and batch costing. Though all of those ones, they are just within the specific order costing, which is as per the customer's specifications or customer's requirements. But this process costing, for it, it's a bit different. It's one of the costing methods where we accumulate costs on the products that are produced using different processes or departments, but each process is having a different operation, and the costs incurred there are different in each department, but we produce commodities that are identical or standard, and they are not as a requirement of the customer's demands. We produce whatever we are producing so long as it is identical, homogeneous commodities. We produce, if it is cement, we produce cement. If it is soda, we produce soda. So that's what we are going to be talking about. The other costing method, which we have the backflash method and the hybrid method. Of course, those ones, they are not part of our syllabus, but we can talk about them. Maybe we can talk about them later, because what I want to first concentrate on is the process costing, because for it has a bit of complicated computation, especially when they are work in progresses and they are degree of completion there. That's why I chose to first begin with this. But the other ones, they are a bit okay. If you know how to absorb overheads, then you can be able to handle the job costing and the badge costing. The one which is a bit unique is the contract costing. That one we shall look at it. But without wasting time, allow me kick off with what we have for now, since we've known that this is a costing method that is part of the other two, that the other three we are not going, we've mentioned, and we are saying process costing refers to or represents cost accumulation method that establish the cost of a product or the cost of products, services, activities, or a job that passes through a series of sequential stages before they become complete products. Here, what we are saying is that we make sure that the products we are producing, they are going through a different stages. And in each stage, we use the different raw materials and we incur different costs in the production. Because if these processes were similar, then we would be having only one process that could help us to produce those items until they are done. So we have different stages, and at different stages or at different department or process, we have different activities and we incur different costs. But what we are producing or what we are looking at is a final product that is that is standard and homogeneous. You can also define it as the form of operation which is used where standardized goods are produced in large volumes or large numbers with a continuous production flow or departments. And the other person can call them cost centers. These are different departments, but they are within the production. So we are saying that the products, are not manufactured to meet customers' specific requirements, because in the other methods like job costing, you find that the person is producing only according to what the customer wants. If let's say someone is manufacturing let's say a chair, if it is in a carpentry workshop, you find that someone does exactly what the client wants. But this one, since we produce in large numbers, we don't have customers' specifications. We just produce, whoever finds them, they will buy. That's how it is. So we are saying that process costing, it is just a process by process, meaning what comes from process A goes to process B, and the other one goes to process C until the finished goods are produced. So what we are expecting is that we can talk about some of the industries where we use some of these process costing, so that we can know how this is done. Some of the industries, we have the breweries, we have those who are manufacturing sodas, beers, and others. Of course, you find that the company is delivering exactly the same product. They may be just different by name, but all of them, they're using almost similar resources. So we have the textile industries, these were making clothes and others. We have the cement industries, the paper making, and finally, we can talk about the oil processing or oil refinery. You find that for the oil to be complete, you find that they are extracting the crude oils from somewhere, they are putting it to a different place, and different activities are done in where they have taken the first one, or the inputs from another process. We can talk about it in terms of the non-manufacturing industries, because there are other scenarios when we can use them and they are not in the production. One, we have the check clearings in the bank. When you are clearing, when banks, they are clearing those checks, if let's say one submits a check and supposed to be paid to another bank, you find that what the process they go through, they follow certain stages, that if you start with this one, you end with this until the money is deposited to the other person's account. We have the mail sorting in the post offices and others. Of course, these post offices, most of the times you find that they are because of the technologies and these social media platforms, they make the use of post offices to be at least of less use these days because of the technology, but we used to have that. And having known what process costing is all about, we can try to look at the flow. How do materials flow from stages to different stages until the output or the final products are produced? Now we are looking at how or how these costs are flowing within the process costing, the flow of costs in the process costing, the process costing system. We are saying that production moves from one process to the next until final completion occurs. What we are saying that if you put in raw materials, let's say in process A, it moves from process A until we reach to the final process that gives out the final products, and we take those products to the store. We are saying when that process is occurring, there are some things we have to note. The first one, we talk about the cost that we are incurring in the processes. The costs we are incurring in process, let's say process A, when you use the diagram below, the costs we are incurring in process A, we transfer them to process B. Remember, in process B, you may find that there are other costs which are existing there, but they are not existing in process A. So we bring the costs we've got from process A, we add to those ones we found in the process B, and the process goes on until we get the finished goods out of the last process. We are saying that each production department performs some part of the total operation and transfers its completed production to the next process. When it transfers that, then we expect that what it has transferred becomes the input for the other process. The input of this process A becomes the output of process A becomes the input of process B, and the output of process B becomes the input of process C until we get the finished goods. Hope you can get that. And the main aim as to why we are going through this process or these operations, we want to change the raw materials into finished goods. And how are we converting these raw materials into finished goods? By adding other conversional costs. We say that conversional costs, those are the costs that are helping in the conversion of raw materials into finished products. And when we get these units, then we can take them to store. Either we sell them or we take them for other stock taking and other computations that may happen, and we know how much we've incurred and what output have we got. We try to compare it with the input, and we try to see whether we've made a profit or we've made a loss, depending on the number of units we produced. Then we are still on the flow, and we say that this just explains what I've been telling you, that products which are coming from process A goes to process B, and they become the input for process C. And say that the costs of process A are transferred to process B. The process B costs are then added to this cost, and the resulting total cost is transferred to the process C, where the process C costs are then added to this cost, the cost we've got from B, and therefore the costs becoming cumulative as production proceeds, and the addition of the cost from the last department is cost represent the total cost of production. What we get out of this production, this process C, becomes our final output, and the total cost we've incurred in that, the accumulation of the costs we've got from A, B up to C, we sum up and we say that these are the costs we've used in the production. So having known that we've got the units and we've already estimated or we've already calculated the costs, we've incurred in the production of those units that have moved out, we witness some effects. One, when you're doing production, we expect that the items, if let's say you enter 10,000 units in the production process A, we expect that when you put in 10,000, we don't expect that we are going to be getting exactly 10,000 as in output, because we expect that there are some normal losses that may occur within, and those normal losses, they may come as a result. You might find that the nature of some raw materials, you may find that some raw materials can even evaporate. If let's say they are just in liquid form, they can evaporate, which will cause a mismatch between what we've put in and what comes out. So we expect two things. We expect that what we have put in is not exactly what we are going to be getting out of the process. So if it is true, then we expect that we are going to be having normal losses. And we are saying normal losses, those are losses we expect to incur, and the management has no control about them. They become they may come as a result of natural factors, machine. You find that there are natural factors that may occur and cause the production to incur losses. We expect that the nature of the material themselves, they may be of a poor quality, which will make the production or the output to be low, and when we have consumed a lot of the raw materials. So those are the things we expect. So when you come here, if we've got the total cost we've incurred in the process, and we said we expected to incur normal losses, and even the losses, the other losses may come as a result. The products comes out, but they are not of good quality, especially these. If you are just starting the process, those first items that come out, you may test and we find that they are not at the required standard. And what happens is that when, let's say, we've produced some items and we find that those items, they are not of the quality we wanted, we are not going to throw those items. We may find that those items can be used by different companies that can use them as their raw materials. So what we do, we can even sell them off, but we sell them at a less cost because they are not of a good quality. We reduce the price. So when we have that, realize them, when those normal losses have occurred, and we can realize we can get some money out of the sale of those normal losses, we call that scrap value. That scrap value means it comes as a result of the normal loss in units. We multiply by what they are paying us, and we get the scrap value. So what happens is that when you're trying to determine the total cost of the output of the units we've got, or we are expecting to get from the production, we get what we have incurred in the process as the total process costs. We less those scrap value or the normal loss value, and we divide by the expected output. And to get our expected output, since we said that what we are putting in the system is not exactly what we are supposed to get out as an output, then we expect that we are going to be having a normal loss. So what will happen is that we shall get the input, what we are putting it in the system. If let's say there are 10,000 units, we less the normal loss. If let's say the normal loss is estimated at to be 10% or 5%, we deduct that, what we get will be the expected units. But there is a scenario which happens that even what you have expected is not exactly what you've got. We may say that we are inputting 10,000 units in the system, and you find that the normal loss we assumed to be 10%. And if we are putting in 10,000 units in the system, we expect that if the normal loss is 10,000, sorry, it is 10%, it will be 1,000. So it will be the 10,000 minus the 1,000, which will give us the 9,000. So what happens is that when you're expecting to receive 9,000 as in terms of the expected output, but what comes out of the process, we find that we've produced, or we've got only 8,000 instead of the 9,000. We just know that we've incurred an abnormal loss. So an abnormal loss means that is a loss that if we had taken a good precaution, we could avoid that loss so that we get the expected output. But since we have not got that, it means we've incurred a normal loss, sorry, an abnormal loss of 1,000 units. And to a surprise, you may find that your expected output was supposed to be 10,000, sorry, 9,000. If you had put in 10,000 units and the normal loss was 10%, which was 1,000. And you may find that when the actual production occurs, we've incurred, or we've produced out of, we've got, let's say, 10,500 from the production. We shall say that since we expected to produce 9,000 and we've incurred 10,500, that 1,500, which is in excess of our expected unit, will be our abnormal gain. So it means we've got, at least we've got, it's like a profit. So you've got that. So I hope you can get now the difference between the expected output and the actual output themselves. What comes out, the difference between the expected output and the actual output becomes either an abnormal gain or abnormal loss. That's how we compute that, but don't worry, we shall see all of those ones when you go to the computations. But you just keep in mind the formula for defining the cost, for determining the cost per unit of the production process. We get what we've incurred or what we've put in as in the process cost, total process cost, we less the scrap value, and we said to get the scrap value, it's our normal loss in units. We multiply by the selling price in the selling price of the normal losses. Don't worry, this normal loss figure they will give you in the question, and the selling price of the normal loss they will give you in the question. We divide by our expected output. We are dividing by the expected output, not the actual output. And to get our expected output, we said it is the input minus the normal loss. Okay, we are saying that at every stage or at every process account and other accounts are opened and debited with all the costs incurred in the production. You should remember this. It is debited with all the costs that are incurred in the production and the gain, if any. These are the two things we debit on the normal. We debit on the process account. The reason why we are debiting them, because they are expenses, we have incurred them. If they are expenses, you know from accounting that expenses we debit because we have given out money. It means we've incurred some money, we have lost cash, we credit our cash, then we debit the process account, And here, what happens is that when we get the output, then this output is supposed to be credited. The reason why it is credited, because it is coming out as what we've got in terms of what we've put in. And all of those gains and losses, you now know where to put them. So I can just give you an illustration of how, or a format, you have a look at how this process account looks like, and we shall continue to learn more as we go to the computations, but you have to get this theory in your memories, because it's this theory that helps us to get the computation when we know where we are heading. So that's the format of a process account. And we have this column is for, you can call them items or particulars or details. We have the units. It's a T account. It's a ledger account, actually. It's a ledger account which has both, this is the debit side and this is the credit side from your accounting. We said we debit this process account with all the costs we've incurred. These are the costs: material costs, labor cost, overhead cost. If we had even the direct expenses, we also put them, so long as they are expenses and we've incurred them in the production, you debit them. And we also will put the abnormal gain. The reason as why we are putting the abnormal gain, it's like a profit, we've earned it. But if it is a loss is reducing on our costs. That's why it is credited. All the losses are put on the credit side, because we are reducing. If you put this loss this side, it means we are reducing on what we've put in as the cost. So that's how this looks like. And the reason why we are putting closing stock and output is, one, that you may find that we have some closing stock that was at a certain degree of completion. Those ones we shall see them. The likes of equivalent production, those ones we shall see them when we go ahead with this. So what I want you to do is to make sure you subscribe so that you be able to have this information and you'll be able to learn more. Thank you for watching.